Interesting developments already in our grain trade, and we're just getting the trading week underway. I'm Marlin Bohling, your tour guide to the ag commodities. I want to take a look at the corn market right now. Remember, we started under pressure. We had overnight trade showing double-digit losses across the board. Well, now July corn is still lower, but it's only, in air quotes, 6 1/4 lower, now 6 lower at 653.5 as it starts to gravitate upward just a little bit from its overnight lows. December corn currently down 12 3/4 cents, and it's now trading at 5.34 per bushel. Let's move on to the soybean trade here, and this is interesting. You had the July contract. It had gotten as low as 15.06 1/4 overnight, and now we're up within a penny of our high. We have the last trade at 15.24 3/4. That's only a penny and a half lower now. And we have November new crop beans down 5 3/4 cents at 13.54 3/4, and now 13.55. Well, let's check out our wheat trade, and we'll start in Chicago with our quotes provided by Bar Chart. We have July Chicago wheat dropping 12 1/4 cents. We're at 6.62 per bushel right now. In Kansas City wheat, we currently have July trading an even dime to the downside. That would put it at 6.14 per bushel. And in the Minneapolis market, right now, you have the July contract trading 15 1/4 lower. We're at 6.85 1/4 per bushel. And here's a bit of a surprise. Oats. This morning, we have July oats 3 higher. 3.59 per bushel. September up 5 1/4. What's that old saying? Let's ask Chris Swift of Swift Trading. He's based in Nashville. What's the old saying?
I don't remember.
You don't want to say it,
I
do you?
don't remember.
Yeah, they used to say oats knows, but the question is, why is oats going higher when everything else is lower today? That's curious.
It is, and I can only assume it's still some of the dry weather up in that oat growing area. I know that John and them had been out on the wheat tour last week and seen quite a bit of really good wheat, and that's probably some of the reason why it's down this morning. But the corn market is probably the most interesting, watching it come back off those lows overnight.
What's going on with that anyway? Corn and
I think the undertone. I think there's just such a great undertone due to the lower dollar and a seeming greater push by the Fed to want to keep stimulus going rather than combat inflation.
I talked with some analysts that work in the cash grain merchandising industry last week, and I said, so after the sell-off from the contract highs that we had, have you seen a big pickup in farmers selling? And they said it's crickets. Nobody is selling anything.
Right.
So what does that tell you?
Well, I think they're holding on for higher prices. We look at the big discount to the new crop, and we can clearly see $1 plus in some cases a discount there. So I think that it's probably worth waiting a little bit to see what may happen as we get into the summer rather than being so early. We've seen farmers sell really early a lot of times, and breaks like that tend to get them to move. But there are true issues of shortages out in the country, and we know that some chicken plants are having to pay premium for corn just to get it there. And we know that this year's crop may be really big. There's no doubt about it. They're going to get 100% of the corn crop in the ground, and I've even heard rumors of 1 or 2 million acres more that they have found out there.
It's going to be hard to say. Isn't it interesting, though, that the last 2 weeks we had like 11 or 12 million tons of corn that sold to China. They went down, and now here we haven't had any sales for a couple of days, and it may go higher. That's a little odd in itself. So
it is. It is. But, you know, I think a lot of times some of those purchases are already made, and then we get to hear about them a little bit later on.
That's absolutely true. Yeah. Absolutely true. Yeah. That's a great point. All right, we'll come back in just a moment, and we'll talk about our livestock trade in just a moment. How are we opening up in our livestock trade and performing about a half hour into it? Let's take a look. On the live cattle board, we have triple-digit losses all across the board here, Chris. We have June down $1.07. We have the August contract now down $1.22 at $119.70. Is this a direct correlation to that cattle on feed report that came out Friday, do you think?
I think it's a combination of both. And even though they opened up the slaughter rates tremendously last week, killing 669,000 head, that was a tremendous improvement over the 645 and 646 that they had been. But it's still, we're probably not going to see much more higher box beef prices. And if slaughter continues to stay at 669, things go back to kind of an even keel again. And I really don't see much bullishness or bearishness from that report.
If we could, I wanted to take a look at those cattle on feed numbers in case somebody just tuned in and missed them earlier in the broadcast. This is what the trade was looking for and what they actually were. So the on-feed number, the trade thought it would be 103.7% of a year ago. It came in at 105, a little higher than expected. The placements, really a bit of a surprise. Trade was guessing 120.8%. It came in at 127%. That was quite a bit over the initial guess there. The marketing's number was very close, though, at 133%. But that placements number, did you think that would have more impact than what it did?
Not really. We kind of assumed that they would have a little bit higher placement for the month of April. May is what's going to be the most interesting. I'm not real sure that you're going to see a heavy placement month for May. And when we look at the actual numbers of cattle on feed, 11.77, at 12 million is a lot of cattle on feed. So just up underneath that 11.77, that's still a lot of cattle on feed. If you could get it under 11.5, 11.4, then I think you could probably get current pretty quick.
Even in the May report, though, it would still, if you consider percentages this year versus a year ago, it's still like apples and oranges, right?
Oh, absolutely. Clearly, because of last year's disruption that we had on there. And so a lot of people are just looking at the year of 2019, where it was fairly normal, and then use the 5-year average both. And this is right in line with the 2019 levels there. So we're not losing numbers of cattle on feed by any numbers, but we're not gaining them as we have been before in the past either. And maybe this summer we kind of find out whether or not we stay this way and stay pretty current, or unfortunately, if the drought persists, then we'll have to move more cattle on feed.
Let's look at the feeder cattle market right now, and our quotes provided by Bar Chart. Well, we are lower, but not nearly as much as what we're seeing in the live cattle. The August feeders only down 30 cents at 153.40, and September down 40 cents at 154.55. Now it's down only 35. Are you surprised by that they're performing better than the live?
A little bit, because we are all very confused on the input cost. We see corn prices really elevated, and we see fat cattle prices not gaining, and then all of a sudden the feeder cattle prices continue to hold their gains, especially more so in the futures than what they do in the cash. But it's a little confusing to see how difficult these input costs are going to be to overcome, and still not seeing any breaks in the market.
Going to get you updated on our lean hog trade, and right now on the futures board, remember we had that July contract limit up last Friday. It's down 67 cents today at 115.87. Kind of taking a breather the way it looks. August is down 37 cents at 111.65. Actually, relatively quiet. That's how things are shaping up in the market so far. Thanks, Chris, for coming in. Good
Absolutely.
to see you again.
Always
Chris
a pleasure.
Swift Trading. Janet, I'll turn it back to you.